Insurance exam prep types of insurance companies. Question 1. An insurance company owned by its policyholders is a stock company, mutual company, fraternal benefit society, reciprocal exchange. Mutual insurance companies are owned by the policyholders who may receive non-taxable dividends. Question 2. An insurance company owned by shareholders/stockholders is a stock company, mutual company, fraternal company, Lloyd's Association. Stock companies are owned by investors/shareholders who receive taxable corporate dividends. Question 3. Dividends issued by a mutual company are considered taxable capital gains, guaranteed returns, return of excess premium, employee bonuses. Mutual policy dividends are not guaranteed and are legally considered a return of excess, overcharged premium. Question 4. A fraternal benefit society provides insurance primarily to the general public, its members, shareholders, government employees. Fraternals are social organizations that provide insurance solely to their members and operate on a lodge system. Question 5. Which type of company is an unincorporated group of subscribers managed by an attorney in fact? Mutual company, reciprocal exchange, stock company, fraternal society. Reciprocals involve subscribers indemnifying each other, managed by a designated attorney in fact. Question 6. Lloyd's of London is technically a mutual insurer, a stock insurer, not an insurance company, a government agency. Lloyd's is not an insurance company, but an association of individuals and syndicates that individually underwrite risks. Question 7. An insurer created by a parent company to insure its own risks is a captive insurer, mutual insurer, fraternal insurer, reinsurer. Captive insurers are formed by corporations primarily to finance and insure their own risks. Question 8. A company that provides insurance to other insurance companies is a reciprocal, reinsurer, fraternal, surplus lines insurer. Reinsurers accept risk from primary insurers to protect them from catastrophic losses. Question 9. When a primary insurer transfers a portion of its risk to a reinsurer, it is called ceding, twisting, rebating, retaining. The process of transferring risk to a reinsurer is known as ceding. Question 10. Which organization provides insurance for risks that admitted carriers won't cover? State Guarantee Fund, surplus lines insurer, fraternal society, mutual insurer. Surplus lines insurers cover high risk or unusual exposures that admitted, standard carriers decline. Question 11. A risk retention group, RRG, primarily provides which type of coverage? Life insurance, health insurance, liability insurance, auto insurance. RRGs are specialized liability insurance companies owned by their members who share similar risks. Question 12. An insurer owned by the government is considered a private insurer, commercial insurer, federal state insurer, mutual insurer. Government programs, like Medicare, FEMA, Social Security, are public insurers, distinct from private insurers. Question 13. Which type of policy pays dividends? Non-participating, participating, term, guaranteed. Participating policies, usually issued by mutuals, are eligible to receive policy dividends. Question 14. Stock insurers typically issue which type of policies? Participating, non-participating, assessable, fraternal. Stock insurers generally issue non-participating policies, where profits go to shareholders, not policyholders. Question 15. If a mutual company converts to a stock company, the process is called demutualization, incorporation, reinsurance, subrogation. Demutualization is the legal process where a mutual insurer transitions into a stock company. Question 16. A home service or debit life insurance company specializes in million-dollar policies, small face amounts collected weekly/monthly at the home, commercial liability, reinsurance. Industrial or home service insurers sell low face amount policies with premiums historically collected at the insured's door. Question 17. Which is not a private insurance company? Stock insurer, mutual insurer, National Flood Insurance Program, NFIP, fraternal society. The NFIP is a federal government program, not a private insurance entity. Question 18. What characterizes an assessable mutual company? They pay stock dividends. They can charge policyholders additional premiums if reserves are low. They are owned by the state. They only sell life insurance. Assessable mutuals can legally demand additional premium from policyholders if claims exceed funds. Question 19. An alien insurance company is formed under the laws of another state, the federal government, another country, a fraternal order. Alien insurers are incorporated and formed in a country outside of the United States. Question 20. A foreign insurer in Florida is a company incorporated in Florida, any U.S. state other than Florida, Mexico, Canada. A foreign insurer is incorporated in a different U.S. state than the one where it is currently doing business.